So I want to talk about two loans this morning that I think are potentially of value. I know they are a little bit for some of you, but the first loan I want to talk about, which is brand new for our company, is the doctor loan. They introduced it on, I saw it this morning. It got introduced on Friday. I was out, and so we've now got a doctor loan. Now, I wish I could give you a lot of particulars. It does go to 99% financing, does have mortgage insurance on it. There's various products. You can do a 30-year, you can do a 7-year, you can do a 10-year ARM. So it's got various options to it. It does have some debt-to-income ratios that we have to monitor, much like we do on any loan, but there's lots of flexibility with it. Credit scores, 640 and on up. So a lot of people that are coming out of residency will qualify. So the traditional doctor's loan that you've used in the past, this is going to be basically that loan. I think the only difference is some of the product that's out there is 100% financing with no MI. But really it has MI because they bump up the rate. So this product is going to have MI, but it'll have a more traditional rate. So underwriting, we do it all. This is a portfolio product for us, so it'll be our loan that's going to be held in our portfolio. So I am so glad we've got that product. Not that we'll do a ton of it, but you're going to have clients from time to time that would like an alternative. And here's a way to have an alternative and keep control of the process. If you've dealt with the doctor loans in the past, and I know Worrell has, you don't always get the communication you're looking for. So at least if you're working with me and our organization, you know you're going to get the communication that you're used to. Lanier.
If they do want to put money down, is it 20% to get mortgage insurance off?
Yes. Mm-hmm.
And then a lower rate?
Right. If they want to get rid of mortgage insurance, they do have to put 20% down. The rate difference is going to be driven a little bit more by the DTI than and the credit score than it will the loan to value.
So is the advantage of the doctor loan that your portfolio offers is just down payment assistance?
Normally, that's why people are doing that loan, is down payment. You're exactly right. And again, it's one of those things where if I'm working with your client, I'm going to look at both products. And we're going to take a look at both products and see, traditional and the doctor loan, see which one's best and better for them, and they can make a decision. But I can tell you this, most people that are coming out of residency that are, they're getting started, they don't have a lot of cash unless mom and dad have a rather substantial amount of money, because they don't. They've just been, my son's a physician, so I know what it was like when he came out. And so the 100% financing or near that is oftentimes what a lot of people are looking for. They don't have to, though.
So is the MI comparable to a traditional loan?
Yeah, very much the same.
So if you put like 2% or 3%, whatever that would be.
Yeah, it's going to be very much the same. It's not, it's not bad. High level stuff, okay. Lead conversion structure. No, we're not going to erase the board today. So doctor loan's now finally there. I'm glad that I can have it. I know I had it some years ago, but it's a good alternative when you come across somebody. You can at least talk about it, and now you know that we've got it in-house, which is a blessing. But the other loan I want to talk about this morning, because it's coming up over and over and over. I don't know why all of a sudden everybody that is self-employed is coming out of the woodwork, but the bank statement loan. Now, some of you are a little bit familiar with the bank statement loan. Have any of you done a bank statement loan? Nothing. Casey, you've done one. No one. Have you heard about the bank statement loan? You're nodding your heads. You've heard about it. Okay. So here's what happens. First of all, it is designed for people who are self-employed. If you're not self-employed, you cannot do the bank statement loan. That's not going to happen. We don't, at least the lenders that we send loans to do not want no income verification loans. So what they're doing is they offer this product for self-employed. So if you, like me, I couldn't get it because I'm not self-employed. You are considered self-employed, so you could get the product. So the first thing is you've got to be self-employed. Second thing is you got to be self-employed a minimum of 1 year. I got a call yesterday from a client who's, he's been in construction for many years, but he went on his own 6 months ago, thought he'd have no problem getting a loan. And I said, no, I'm sorry, you got to be in, if you want a traditional loan, 2 years. You want to get a bank statement loan, you got to have 1 full year. That's just the way it is. So the first, and that's probably the most important thing to know, got to have at least one year, all right? But it's an excellent product. Now let me just explain, I won't erase Mike's things up there, but let me explain why it is so powerful, even though the interest rate's higher. And I talked about this some weeks ago, but if somebody is making, let's just say that they make general revenue coming in, all right, on their Schedule C tax return. Schedule C on their personal tax return if they're a sole proprietor. So let's just say that they put on there $175,000 a year. That's the revenue coming in. That's not their income. That's the revenue that they show on gross receipts on Schedule C. If they show that, they're probably writing off a fair amount of money. I have one now that I'm doing right now for someone. He's a truck driver. Happens to be somewhere right around that 175, but he writes off a little over $100,000 a year. Now think about that for a minute. He's writing off $100,000 a year. Some of that is, well, all of it's legitimate, right? And but that $100,000 a year is saving him in personal income tax probably $30,000 in personal income tax. Now, when I quoted him rates, him and his wife a few weeks ago, because they're out looking, I had to quote them rates that were around 9.5 to 9 3/4, which is a good full 2 points above where the market's at right now. Maybe even a little bit more than that, but at least 2 points. Well, that 2 points on in their case, about a $300,000 mortgage, that 2 points is about $400 a month, maybe let's call it $450 a month. Let's make it real simple and call it $5,000 and call it $500 a month. That's $6,000 a year. So they're going to pay roughly $6,000 more for their mortgage payment annually because they're getting a bank statement loan. But think about it. He's saving over $30,000 a year in personal income tax. So how many of us would be worried about the extra $6,000 if we could save 30? I mean, I look at my personal situation. I pay so much in taxes, it's unbelievable. I just don't have any choice. I'm W-2 employee. I don't have the write-offs that you do. You have write-offs because you're real estate agents. You're 1099. So you can write off things that I cannot write off. I can't write off mileage. I mean, I used to be able to, but I can't write off mileage anymore. You can. So there's, as a self-employed individual, you get some real benefits. So the first thing with the bank statement loan, number one, you got to be self-employed at least a year. Number two, it gives you some flexibility on how much you're going to pay in personal income tax, and that number is always going to be substantially less than what you pay additionally toward your mortgage. Does that make sense before I go on? Is that everybody following that number? So that's why I tell my self-employed borrowers who are thinking about a bank statement loan, don't get nervous about the interest rate because it doesn't make any difference. You're saving so much money on personal income tax that the interest rate for a bank statement loan shouldn't make any difference to you. We all want to get as low a rate as we can, but don't worry about it. It's not a big deal because you are saving money. Don't try to adjust your tax returns to qualify for a traditional mortgage. Oh my gosh, don't do that. Take the higher rate, sleep at night, and know you're putting a lot of extra money in the bank. All right, now, the bank statement loan, just So let's take this example, $175,000 of revenue coming in. Now, that's what shows up on the tax return. That's not the income we're going to necessarily give them. So what we're going to do is we're going to ask them for 12 or 24 months of bank statements. There's a couple different products. There's actually one that's only a 3 and 4 month bank statement loan, which I don't do, but I know it's out there. And there's a 12 and a 24 month, typically 12 months. What we do is we collect from them bank statements that are going to be for a minimum of 12 months, every month in sequence. Now, sometimes I have to get both personal bank statements and business bank statements. Now, what we're going to look for when we get those bank statements is the money coming in from the business. So if this one gentleman's a truck driver, so he gets checks from the people that he contracts to. So all of that money that goes into his account, we can account for. So in his case, we were pretty much able to use all $175,000 that we were able to account for, pretty close to it. It was a little bit less. He had some other things in there. We couldn't account where the money came from, so we don't give him credit for that. But let's just say that that number is $165,000 that we give him credit for. What we did then do is the starting point is 50%. So I take the $165,000, cut it in half. In that example, that's just over $80,000. That's his annual income, $85,000. In that example. Now, it's 50%. But because he happens to be sole proprietor, he's a truck driver, he has no employees, he has no office, he has none of that. Well, when I went to submit it, they said, well, Greg, we're not going to take 50%, we're only going to take 75%. We're going to give him credit for 75%. Instead of wiping out 50%, we're only going to wipe out 25%. He's sole proprietor by himself, doesn't have all those other expenses that a lot of businesses have. So his income, instead of being 80 grand, was actually closer to 120,000 that we were able to use. Now, two different ways. One, I can take the money from the business, if that's what he's doing. The other, I can take the money if it's going into his personal account. But if it's going into his business account, then there's some other documentation that the lender has to be able to demonstrate that we've got that we wouldn't otherwise have to do. If it goes into personal, we require one thing, we're going to take money from the business to something else. But in either case, 12 months of the total revenue that comes out of the bank, that's going into his bank account. Well, think about that. If somebody's getting $160,000 or $170,000 or $200,000 in their bank because they're a sole proprietor, such as you, 1099, oh my gosh. Even if I only use 50%, that's a tremendous amount of income that the person on the street can't take advantage of. So the bank statement loan can help get people qualified. Now, before I go on, any questions? I want to keep going on the bank statement, but any questions thus far? All right, next thing is credit. The higher the credit score, the better the interest rate. No different than on a traditional loan. We've got one right now where I've got somebody that has a 676 credit score. They're getting a bank statement loan. The bank statement loan does, now this is an investment property, not a personal residence. So on that investment property, he's going to be paying a little bit higher. He's going to be paying 9 7/8. And he's also got a prepayment penalty on it. Most primary residence does not have a prepayment penalty on it. Don't have to worry. If it's an investment, then they can put a prepayment penalty on it. But the beauty of that is most people are getting it for their primary residence. I mean, it's just a traditional security deed, no difference, no prepayment penalties. They can pay it off whenever they want. They can refinance it whenever they want. So it's a big benefit. But if they're going to be up at 9.5, 9 3/4, and interest rates should come down in the next year, they're going to come down on that product as well. And they can refinance it. So that bank statement product is to me, for you, you don't have to remember all the details. The bank statement loan should be that talking point. You know, Mike is always talking about how you need to have content, that you can talk about something. This is a great product to talk about. You can just, not everybody's self-employed, but you're going to hit somebody on social media that is self-employed that happens to see your reel, whatever it happens. It's just short and sweet. Yes, Casey?
Is there another name for doctor's loan? Are there any other alternate names?
Names? I don't think so. I've never heard it called anything but a doctor loan.
Okay,
Why do you ask? Just curious.
it's marketing.
Okay. I haven't heard it called anything other than a doctor loan.
Okay.
So I think between having that product now and having a bank statement product, that bank statement product is strong. It is really a good, to me, it's an excellent loan. And it provides a good alternative for someone who's self-employed without having them to jury rig and worry about tax returns or anything else. They just have to have decent credit. So, anything on that? All right. Did anybody happen to see in the last, I think it came out 3 weeks ago, anybody happen to see Dave Ramsey's take on the question, should you buy a house now? You see that?
Doubling down on it, but I didn't see it.
What's that?
I heard he's doubling down on it, but I didn't see it.
Unbelievable. His comment was, this is the best time to buy. This is the best time to buy. And the interviewer asked the second question, says, well, how can it be the best time to buy when interest rates are high? He says, because housing prices are going to keep going up and you can just refinance out of it when interest rates come back down, which is the message you and I have been talking about now for months. This is a fabulous time to buy. And even for that self-employed borrower, don't let people get freaked out over interest rates. The self-employed borrower who's going to get a bank statement loan, so what? Just do it. There's ways to make this work for your clients. And again, in a lot of cases, it's nothing more than you having talking points. When you're on the phone with somebody and they're asking questions and you can introduce something, whether they're going to use it or not, whether it applies to their specific situation or not, it makes you and I look that much more informed. The more informed we are, the more competent we are, the more competent that they feel we are, the greater chance we have of building trust. And that's really what we want to do. So, David.
Speaking of that, I was talking to a gentleman this morning whose house came off the market and he's looking to purchase something. And he said, I think I'm going to wait till spring because of the interest rates. And I said, oh, have you looked at a 5-1 or a 7-1? He goes, yeah, they just seem so risky. What talking points could I use in a situation like that if it comes up?
If somebody thinks a 5-1 or a 7-1 are too risky, well, first of all, the only way that you'd think a 5-1 or 7-1 is too risky is if you thought interest rates are not coming back down. If you thought they're not coming down in 5 or 7 years, then that would be too risky. But then I would ask the question, when was the last time that a 5 or 7 year product was an actual product to be thought of in the marketplace where in that 5 to 7 years, interest rates did not come down that you could have refinanced out? When did that happen in the last, say, 30 years? And the answer is it hasn't.
There's been no 5 to 7 year period where interest rates have not dropped.
Yeah, interest rates have dropped at least. Now, again, there's some 5-year products out there that are, or that were low, relative, and I say relatively low, between 4 3/4 and 5 3/4. So it may not be that the rate's going to drop down to 3 3/4 or 4, but if you're into the loan for 2 years and you've got a 5-year product and you've got a 5% interest rate and the rate comes down to 5%, and you say, I'm not moving out of this house for, now I'm kind of here for the next maybe 10 years, well, just refinance it at that 5% rate. So it doesn't mean that you have to go all the way back down. And somebody says, but then I got to pay all those costs, blah, 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 blah. Okay, it's one of two things. The risk of that loan turning into an adjustable versus the small cost you're going to pay to just put it into a fixed rate loan.
And how much equity have you built in those 2 years as opposed to the fees you have to pay?
Thank you, David. you've got more than enough equity. You're not going to write a check. It's going to come out of the equity. Don't worry about it. Just put yourself in a position. Now, if you think you're going to move out of the house in the next 3 to 4 or 5 years, well, then don't do it. Or maybe do another 5-year. Who cares?
But you're saying, just to avoid some smart ass on TikTok when I post this later, you're saying there has not been a consecutive 5-year period in the last 30 years where interest rates have either A, stayed the same, or B, rose.
No, no matter when it has. I got into business 1990, and interest rates dropped between 1990 and the end of 1992, beginning of 1993. Then interest rates went back up again. Then they came back down again. We had an increase, I think it was 96. Might have been 95. 95, 96, interest rates started creeping up. We were doing a lot of 7-year balloons back then. 1998, bam, came down. You know, and if you look at the charts, you can just Google it and it'll show you the chart on where interest rates were at over all these years. But I don't know, in fact, I know you can't find a 5 or 7 year period where interest rates never came down at least once. And even since 2008, if you go back to 2008, which is, and you've been hearing me say this, the presidential election's coming up in less than 2 years now. Since 2008, every presidential election year, at some point during that year, interest rates have come down. That's why I keep telling Michelle, my wife, I said, don't plan any vacations for 2024. I don't know if we'll start refinancing people next year, but you can be assured in 2024, everybody we've done loans for in 2022 is going to refinance in 2024 because rates will come down. At some point, it just will. Now again,
Rates are high, which make 571 arms
attractive now.
They've never gone more than probably 2 years before they came back down.
Because they come back down again. Maybe 3 years, but in that 2 to 3 year window, at some point they come down and you just refinance it. We were doing a lot of, at one point, 7-year, they don't have it anymore. They used to have a 7-year balloon. They don't have that product anymore. But we used to do a lot of that back in the 90s and early 2000s.
But you're saying if every 5 years, are you talking like, so from the point, like today, if you go 5 years now, it's like 9 or 8, whatever, 8%, right, we're at?
Or 7.
Okay, 7.
7.
And so if we go 5 years from now, you're saying between now and 5 years, the rate would drop between, so say I bought
It's going to, yeah, if
it would go below 7.
it's going to go below, right, correct.
At some point.
At some point in the next
Got it.
five, it's going to. There's no doubt. There is no
Your
doubt.
5-1 and 7-1s, is there a minimum down payment?
I'm sorry?
Your 5-1 and 7-1s, is there a minimum down payment?
5%.
5.
5%. You know, you get, now mind you, I think, did I mention this last week? There's 2 different 5-1, 7-1, 10-1 products. There's 2 different products. There's the Fannie Mae Freddie Mac product, which quite frankly stinks because the pricing's not very good. And then there's the portfolio, the bank portfolio products. Like today I told you, we introduced the doctor loan. That's a bank portfolio product. We hold it in-house. I keep bugging my bank to say, I want either a 5-year or 7-year product. I want that product because I want the bank to hold it because then I can get a better interest rate. Because if I have to go to Fannie Mae, Freddie Mac, it just doesn't pay. It's just not that, I mean, the product isn't that good. You pay too much for it. So, but the banks, some institutions are filling up their portfolio with some of that product. They are praying, by the way, that interest rates will kind of subside a little bit because of what happens with their capital requirements if rates kept going up. So, all right? Anything else?
So your portfolios are 5% down?
What's that?
Your portfolio ones are 5% down?
Yes.
Okay.
Yeah, but we don't, no, we're not doing a 5171 portfolio.
Oh, you don't?
No, we don't have that. No. The only 5171 we have is through Fannie Mae, Freddie Mac.
Gotcha.
But we
So
don't
you
have a
any
portfolio.
portfolio
No,
ones? Okay.
not on that one. All right, good. Thanks, everybody.